Hello, everybody, and welcome to episode number 57 of Confessions of a Market Maker. I'm your co-host, Ray, aka All Day Ray, aka the short-selling activist. And I'm joined here by my buoyant co-host, former market maker, 20 years, and current day retail trader, a man hated by many, loved by few, and feared by all, a man who single-handedly held the stock over 80 RSI for 180 days straight. The man who taught you how to think like a villain, aka JJ Luther. JJ, how's it going?
Hey, good, brother. How you doing?
I'm doing great, man. Doing great. And our guest today is a systematic trader who was featured in the Unknown Market Wizards' latest book of a legendary series of trading books. A man whose annual compounded return during the past 20 years was 20%. And that's more than triple the 5.7% return of the S&P during that period. A man who's accomplished violinist and programmer. I'm, of course, talking about Marsten Parker. Marsten, how's it going, man?
Hey, good. Thanks for having me on. It's my second podcast of my entire life.
All right. Excellent.
I'm looking forward to it.
Awesome, man. I really appreciate you joining us. I wanted to start off asking you, in the book, you brought up a point when you met Jim Simons, or Jim Simons was involved with merger negotiations. He was an investor in the company that I guess bought you guys out, or for exchange for some stock. And what I found funny, because we talked to the author of the book, The Man Who Solved the Market.
Mm-hmm.
And the one thing he brought up was how, like, in order for him to interview Jim Simons, he had to been able to smoke, and that Jim Simons was smoking, ashing in coffee mugs. You brought up the same thing, that for you guys, Jim Simons had to be able to smoke, or like, I guess, so I guess when you're rich, you can just do whatever you want, huh?
Yeah. I mean, I don't know if he still is, but he was a chain smoker. But yeah, as is pointed out in that book, which is an excellent book, in the late 80s and early 90s, his main thing was venture capital, while he was kind of transitioning into the Medallion Fund and where they ended up now. I happened to start a little consulting company with 3 colleagues, and then we were subcontractors to this one of the companies Simons had invested in, Segway Software, and on a project of porting Lotus 123 to Unix, which I think never really went anywhere, but that was in 1991. And we were the QA department, the software testing department, and we built some tools to help with that job, which ended up seeming like a good product idea in themselves. So Segway decided to pivot, buy us out, and merge with them. So yeah, Jim Simons was the chairman. I mean, I think he probably came up, this was all in the Boston area, which is where I live. And he probably came up from Long Island, maybe, I don't know, 2 to 4 times a year at most, but, and would be in our office for a day. Generally, it was when there was a board meeting, because he was the chairman of the board. And I think the town where our offices were had probably just, or maybe it was even statewide. That was right around the time that smoking was starting to be illegal indoors, more or less, which thank goodness it still is. But yeah, he, if Jim was in the building, he smoked the entire time, and we just kind of all accepted that fact.
I just thought it was funny because the author, I mean, it had been over a year ago we talked to him, JJ, and like he made a point of emphasizing that. And then when I came across that in your book, and you were like, oh no, we had a strict no smoking policy. I guess this guy just does whatever he's want. I guess when you're a certain net worth, you can get away with whatever. We conform to your rules.
Yeah.
I find a lot of math guys always smoke. I don't know what it is. Like,
stressful, I guess. I don't know.
Yeah, it's the whole ethos of wanting to sit around in a coffee shop and smoke and talk about math for 8 hours in a row or something. Yeah. The other interesting little story from that time is when we were in the software testing business, and I guess in the early days when they were putting the infrastructure for Medallion in place, they were running into some bugs, and he was getting pissed at his programmers, and so he flew down our head of QA from our company to Setauket, and had him lecture all of their programmers on the right way to test software. And I guess it helped because they ended up making a lot of money with that software.
Yeah. So you're Marsten, you're a quantitative guy. Simon's legendary quant, one of my personal favorites, Ed Thorpe. When you were first learning how to trade, or is there a trader that you like looked up towards or gravitated towards?
I read the first Market Wizards book. I think the very first trading book that I ever read was Trading for a Living by what's his name, Alexander Elder, which that was not really a quant approach, but somewhat. I wasn't aware of Ed Thorpe till much more recently. I think Ed Sakota jumped out at me from the original Market Wizards book as the kind of a systematic attitude, but it was really more like I didn't think of myself as a trader. I had some money to invest, and I didn't like the idea of buy and hold because it was 1996, and Alan Greenspan was saying there's irrational exuberance, and so I kind of wanted something shorter term, and I would read things on the internet. So, and I ended up following this guy named Gary B. Smith, who was writing for TheStreet.com.
Yeah.
Because he wrote about his own trading method, and which was mostly systematic. It was actually semi-discretionary entries and completely systematic exits. And then I ended up partnering with him and trading that method for a year, and then kind of morphed it into a fully systematic method, and more or less traded a variation of that for about 15 years. And for those 15 years, which was 1998 until 2012, through 2012, I had no losing years, and I actually averaged 27% a year.
Wow.
And my worst drawdown was 20%. So I had very good stats. But then and that was basically a short-term trend following, kind of like a swing time frame trend following type strategy, or not trend following, but like I was buying breakouts and putting a profit target and a stop basically, and shorting breakdowns. I was always long short. Slightly more than half my money that I made during those years was from the short side.
Mm-hmm. Short side,
yeah. I always liked to have both sides so that one would do well when the other wasn't.
Right. And I plan on asking you a little bit more about that, because some of the I guess conclusions or things you found out about kind of trying to hedge the strategies I thought was kind of interesting. And just a reminder to the listeners, if you guys would like to trade alongside JJ, myself, and a supportive community of traders, come join us at microefutures.com. Marsten, you're a violinist. I am not educated on the topic, but I've heard people say that you use different sides of your brain, I guess, for like arts and music, and then another for math and quantitative topics, yet you excel on a high level at both. What are your thoughts?
Well, I'm really not a real quant. Actually, I've never taken calculus. I didn't do any math in college. I don't know much math. I mean, I think I got a pretty high score on the math SAT, and so I have some aptitude for it, but I've never really studied it to a high level. But yeah, I think people say math and music tend to be correlated. Like people tend to be good at both of those, so maybe there's something there. There's I'm pretty good at programming and coding, and I think that uses both sides of the brain in some ways.
Okay, so it's like programming considered a different realm from like quantitative. Yeah, that's a different.
I think so. Yeah, in the early days of computers, a lot of the best programmers were English majors.
Okay, interesting.
Because it's logic really. It's being able to think schematically, and it's like think in flowcharts.
Right.
It's more like process-oriented logical thinking as opposed to pure math. Like the kind of things Jim Simons can do with visualizing abstract geometry in 17 dimensions or whatever it is. I mean, I can't even begin to imagine what that is.
Yeah, yeah,
and,
no,
and think about all the complex formulas.
right. No, that makes sense. I think, yeah, I think I've probably been looking at it the wrong way. I think,
But like I can do Rubik's Cube. I don't know what part of the brain that is.
Oh, that's cool.
That's sort of both in a way. I can juggle.
Now let me hop in here just really quick. I'm a failed violinist. Okay.
Really?
My mother forced me to practice.
Well, I am too, actually, for that matter. But yeah.
From 5 years old to 10 years old, she forced me to take violin. And my poor dog, we had this Newfoundland dog, and every time I practiced the violin, that poor animal would just howl because I was so horrible on it. Well, who's your favorite violinist?
Oh, that's hard to say. But I mean, the younger generation, I like Hilary Hahn. I like Augustine Hederlich. He's really great. He had a great series of videos during the pandemic. You know, some of the younger ones really kind of that were tech savvy enough hopped right on and started making recordings from their apartments or houses. And he has a whole great series. In fact, he managed to record the entire Bach sonatas and partitas and is going to release them in April, I think.
Oh, cool.
During the time. But and then from the older ones, yeah, David Oistrakh, I would say, is probably right up there. Also Grumio, Arthur Grumio.
Okay.
His elegance and.
Okay, I was expecting a Heifetz, but I was just curious.
Yeah, I mean, Heifetz is the famous one, and yeah, there's certainly nothing wrong with Heifetz.
But Hilary Hahn is amazing. I saw her on YouTube with the Sibelius, and it was just absolutely, beautiful. Yeah.
Yeah. Oh well, if you're a fan of the Sibelius Concerto, which I am, I've even performed it actually.
Wow, really?
Well, quote unquote performed. I played the solo part in a rehearsal with my orchestra about 6 times to help them prepare for the real soloist.
Oh, okay.
But that was fun.
Wow.
I'm an amateur.
Yeah. Oh, but Jay, he went to school for music.
Yeah,
wow,
I did.
There you go. Yeah.
Got a degree.
Yeah, he's serious.
Yeah, he's got a degree. Yeah.
Yeah, for sure. So, sorry, Jay, did you want to jump in again? I'm sorry.
No, go ahead. I just had to get the violin question out of the way.
No, definitely. Awesome. When, Marsten, when we spoke with Jack, he prefaced it before, in our interview, and then also before your interview in the book, that the best returns that he's seen have been done by discretionary traders. So he was kind of even a little reluctant to include you, but because of your longevity, that was the deciding factor. I'm just curious, what are your thoughts or a general take on the topic of being systematic versus discretionary?
Yeah, I mean, that's an interesting question that comes up a lot, is why do the best discretionary traders seem to do better? And certainly in 2020, I mean, I know of some discretionary traders that had fantastic returns. It's hard to pin it down, but I mean, I think discretionary traders develop a kind of intuition of what other people are doing in the market, and know how to basically know when not to put a position on, know when to put a position on based on what it's about to do. And you have, I think that develops over time as you sit there in front of the screen every day and watch things happen. I feel like it's like anything else. You have to practice it and do it repeatedly, and then you build up the skill. I kind of tried to do that to some extent when I first started out, and just didn't like it. I didn't do well at it. It didn't suit me. I don't like making decisions in real time. I'd rather be able to do some research. I mean, of course, there are slower time frame discretionary methods as well.
Yeah.
But as far as from what I've seen, the best discretionary traders I've read about or known are, they really can pinpoint their entries to a moment in time when it's low risk. When you can use a tighter stop and have it be fairly sure it won't be hit. I mean, and whereas a systematic trader, you're running these you're writing rules and backtesting them, and you're basically looking for what's worked best on average. But for any given trade, your entry is probably going to be fairly sloppy. you know, I mean, I'm calculating limit prices for a bunch of symbols and placing those orders before the market opens. I have no idea how that price is going to be relative to the intraday action that ensues.
Oh, interesting.
So,
Right. Right, for sure. JJ, do you have any thoughts on this topic?
Yeah, this is fascinating because I'm a completely discretionary guy because I used to make markets and create buying, and people would always say, you know, do you candlestick charts? And I'm like, I don't read candles, I make them, you know?
right.
So, but this is amazing because I always say, because we have all these levels in our market profile, we use Stadelmeyer's market profile at
Mhm.
Dalton's. And I'll use that to see exactly what the order flow is like around a level. And people will say, should I just buy it? And I'm go, no, you can't buy it until you hit it with some order flow, right? You know, it's like being in a street fight. You can't tell until you get that first punch. But you guys, that way, I can see the difference how you look at something and then, you know, on average, it's going to do this, and so you're prepared to lose X amount. It's an interesting way of looking at the completely two different systems. It's
Right. I mean, it's really, I can see that there would be an advantage if I could really watch every
mhm.
trading setup I have, you know, intraday and find that really fine tune the entry levels. But I don't want, it's kind of a lifestyle choice, really. I don't want to
That's
sit there
true
and
too.
sit
That's
there and
true.
stare
Sitting
at the screen. And plus,
exactly.
you know, I typically have maybe 100 plus setups every day, so I don't think
Oh
I
my
could
goodness. Okay, yeah, that's hard. That's
take in that many. Yeah, it's sort of like a shotgun approach, you might say. Just
interesting.
you know, take, you know, some of them will end up being really good, and hopefully most of the rest will just cancel each other out.
I think the appeal to being systematic to me, and now, meanwhile, I'm part both, right? Like I back test, you know, I program parameters, but I execute myself, and I use my eyes, you know, somewhat, but I am leaning a little bit more towards being systematic. And Marsten, I think the appeal to me, and you can, you know, you can tell me what your thoughts are, is that it almost takes away some of like the psychological weaknesses that we have as human beings, or just the randomness in the market that you can be fooled by with your eyes. I think that's the appeal to me. What are your thoughts?
Yeah, I would agree with that. Like, I really, I don't know, maybe there are some out there, but I've never heard of a discretionary trader who's just like purely ad hoc, purely intuitive. You know, you've got to have some kind of rule set.
Yeah.
Mhm.
You know, maybe your rules are too fuzzy to be programmable as code, and then, you know, it involves some subjective, you know, visual judgment. But you know, there's some kind of rules or method. Now, I've also found from sometimes a discretionary trader has said, "Oh, can you test this for me?" And usually the method they think they're using isn't actually profitable if you test it. But
Right. Yeah.
that's fine. I mean, that I used to think, oh, that means they're a fraud or something. But no, it's to me, it's like it's a framework that helps you focus so that your intuition can kick in and do what it needs to do. So
Makes a lot of sense. For sure.
yeah.
Marsten, do you see this trend continuing with discretionary having higher returns, or do you think we could start seeing an age where systematic could start out producing discretionary traders?
I don't know even how to find the data on that really, but
I guess where the question, yeah, sorry, Marsten, not to cut you off. I guess to like, I guess kind of give you some context where I'm coming from. You see a lot of games that humans cannot beat computers at. Poker, chess, Go, etc.
right.
The market is still something that human beings outproduce computers at. I find that like super fascinating, and I'm just curious: does that trend continue, or do we start seeing it catch up?
It might catch up. I mean, you know, of course, the different. Like, I know you're a former poker player, or maybe a current one. If you take poker, you know, it's a more compact universe, right? I mean, there's a certain number of possible hands, and you know, you can kind of know the probability of any given situation more or less.
Yeah, it's solved. This is a solved game. Yeah.
You know, in the market, it's such a larger universe, right? There's so many different markets, so many stocks, derivatives, all these different traders. I mean, you're really trying to guess how how all these other people are behaving who you don't even, and you don't even have any information about it unless you're JJ and you're making a market. But then you can maybe it becomes a little more probabilistic. But the best the systematic approach, you find if you try to make too specific a rule, you find so few instances that you can't get valid stats about them. And but general rules, like I use in my strategies that do produce 10,000 trades in a historical backtest or whatever, you can find that, okay, it has a positive expectancy over time. On average, it produces an equity curve that looks like this and a drawdown that looks like that. And but you still don't know for any given trade entry, you have no idea what the probability is.
Yeah.
Like the typical stats of a strategy I trade might be, let's say the expectancy per trade is $100 and the average win is 1,000 and the average loss is minus 1,000, right? Generally the expectancy will be like 1/10 of the range of the average win and the average loss. And that's true of pretty much any strategy. So,
did you want to jump in, Jay? Or
no, I'm just learning. I'm learning. I
Okay.
love this because the quantitative side and the math side, I come from the complete sort of like the hooligan street side where you just poke them in the eye and hit the bid. So
Right.
I love to learn because being open-minded in trading is really good. So I love learning from.
Well, I actually had a question to ask you in that regard. Given that, so say I have strategies where I'm calculated some limit prices where I want to enter. Let's say I want to buy if it gets down to a certain price tomorrow. So and let's say it's a thinner stock, so maybe my size would be like 1% of the average volume of that stock. Mm-hmm. So should I, for execution, is it better to show my size on that limit order or to
No.
not show it?
Never show size. We will pick you apart when you show size.
Because I've been experimenting with that, and on some thinner stocks like recent IPOs, it seems like there's people who really would like to find some liquidity, and once you put it there, they take it. But then on some other stocks, you find algos get a penny ahead of you all the time, and then it never gets to you.
Yeah, we were always taught never to show size in the old days, right? Now with these algos, I guess because they can split up a size order so much and route it in so many different ways. In the old days, I would have to pick up 2 phones, my partner, and then the guy, we'd hit 6 phone lines at the same time. Now an algo can go and pick off, 20 market makers in, milliseconds. It's
right.
That technology is fascinating. But yeah, definitely on the situation, I think the thinner stock and one that's a little bit more controlled, you probably would be better just, walk softly and carry a big stick kind of thing, but don't show it.
Right. I've been experimenting with different ways to approach that. I mean, my goal is to get filled at my limit price. But, that's the other kind of difference on the systematic person like me. My goal isn't necessarily. I mean, of course, I want the best fill I can get, like anybody else. But I'm not trying to optimize in that moment. I'm content if I end up with an actual fill, which is what a future backtest will say I would have gotten.
Got it. Okay.
So, if I pick the limit price that I want to enter at, I'm fine to get filled at that price. And I just want to maximize the odds that I'll actually get filled if price touches that level.
Oh, okay. That's fascinating.
That's what I'm looking for. So in that sense, that's where I found it. Because I always had the same assumption as you expressed, that you should never show your size. I'm not talking about, I'm not like some mutual fund trying to put on gargantuan positions. I mean, I'm talking about, 3,000 shares on something that usually trades 300,000 a day.
Oh, that shouldn't be a big problem.
So it's just a fine tuning thing of what makes the odds of getting that limit order actually filled
Yeah, see,
and I assumed that I should just keep it hidden, but then of course it always has to trade through it, or you'll
yeah,
never do. And whereas if I show it, someone will often take it, and sometimes I'll be the the extreme of the day.
oh, that's nice. The what I used to do, and this is how the discretionary guys would do it, is if you're trading something and you want to see how it's trading or where the order flow is, you'd go and hit the bid with 100 shares and see how it
Mhm.
prints. You know,
Mhm.
so that's that's why we're sort of like kind of like the chef that's tasting the soup. Too much salt. Needs a little pepper.
Right.
So yeah.
And of course, I mean, I'm not your typical day trader who's sitting there
Mm,
looking at level 2 and knows all the different market makers and so on. I mean, my decision tree is like, what kind of order should I send to IB smart routing?
got it.
That's the level I'm at here.
That's cool.
Yeah.
So now I'm just sending regular limit orders, but yeah, in advance, so it's
Mhm.
sitting there when price gets near.
So, Marsten, something I think about, and when backtesting is, how do you know that a sample size is sufficient for a certain strategy that you feel comfortable in implementing the backtested strategy?
It's there's no way to really know, but it's kind of a feel thing. But I tend to want to see maybe about 1,000 trades in the backtest.
Okay, 1,000 trades.
That's a rough number.
Sure.
It's strategies that have. There's a danger in backtesting, especially if you get into really short-term strategies, where you'll find that you can find things with huge trade counts and tiny expectancies that have like astronomical Sharpe ratios and really smooth equity curves. But can you actually get those fills? And it's a typical sort of mean reversion strategy where you buy on a dip and sell at the end of that same day. A lot of people use that sort of strategy in the systematic world, and you can fine tune those to have a very high trade count. So you're buying like 100 different symbols every day, and like just take anything that dips by half an ATR
Oh,
or something like that. And then, but if you go and analyze the trades in that backtest, you'll see that all of the profitability from the strategy comes from the subset of trades where your limit order happened to be really near the low of the day. So you're counting on getting filled on all those, or else the thing isn't going to work. So I tend to look for a balance where I want a high enough trade count that I can believe that there's some structural edge there, but also a high enough expectancy so I can believe that I'll actually get filled on them and be able to capture it, even with a little slippage.
Right, yeah, and that's the thing, right? With backtesting is that sometimes the results can be misleading in certain areas. And it's interesting too, because we've had the guy on our podcast. It was a while back, and it's funny. He always talks about this. He says that win rate doesn't matter, and through his experience, that he found some of the best strategies to have low win rates. But obviously the like the profit factor, et cetera, like is really high. Have you found the same things, or do you prefer different
Well, I
strategies?
use a mix. I mean, typically a mean reversion type of strategy will have a higher winning percentage, and but the average win will be no larger than the average loss, maybe smaller. And a trend following kind of strategy will be the opposite.
Right.
And I use a mix. I typically, I mean, a nice mean reversion strategy will have about a 60% win rate, and the average win and average loss will be maybe similar. And a good trend following strategy might have a 40% win rate with the average win like twice the average loss. And if you work out those stats, they both are about the same expectancy.
Right.
So, and what really differentiates those two styles is, in my definition anyway, is basically how you enter and how you exit. I mean, to me, mean reversion is you're entering against price direction and exiting with price direction, and trend following is the exact opposite. The trend following people, enter on a breakout and then sell on a trailing stop.
Yeah, right. A key factor for your systems early in your career was unusual volume. Can you define like what type of unusual volume that you were looking at?
Yeah, that was kind of the idea that O'Neill and Investors Business Daily put forward. You know, they would publish that table every day of ranking the stocks by unusual volume, which is just, you know, yesterday's volume divided by the average volume.
Mm.
So yeah, back then I would look for, I think, at least twice the average volume. So, and that worked especially well before, I think it was sometime around 2005 when the mutual funds figured out that they didn't have to put on these huge block trades and could use algos themselves. But before that, unusual volume, yeah, you could basically just buy any breakout with unusual volume, and it was probably a fund buying thing, and or several funds, and it would take them a couple days to finish. So you could, you know, be like the little pilot fish that caught the middle of that. I mean, it was it was ridiculously easy to use those strategies in the late 90s and early 2000s, but they gradually stopped working. I mean, I went through a process where I had to keep getting earlier. I think Jack talks about this in the book. Of, you know, when I first started out, I would pick my trades after the close and enter the orders for the next open, and then figured out that it would work better if I could get in right before the close, so that I could catch the people who were doing what I used to do. And so that, but then that stopped working in sometime around 05. And that's when I finally got intraday data and started, you know, monitoring all my candidates throughout the day and seeing how much volume there was in the morning and projecting whether it would be twice average at the close, and then getting in earlier. And then that worked really well for the next few years.
It's interesting that you say 05, because that's when Reg Show went into effect, SHO. That changed the order flow a lot.
Yeah.
Yeah.
That probably was related to the fact that my old systems broke right around then.
Yeah.
Interesting.
Marsten, yeah, so you spoke as you progressed through your career, you went into like projecting the volume. Are you able to like share with us how you went about doing that, or is that kind of revealing too much of your system?
Oh no, I don't even use those strategies. Don't even work anymore. I mean, so yeah, I was using. I got a data feed called NCore, Nanex NCore, which is a really good like whole market tick data. At the time it was $400 a month. Now it's like $1,500 a month because the exchanges raised their prices for live data, so I can't afford it anymore. But I don't need it now anyway. I just use daily bars. Okay. But anyway, so yeah, what I did is I measured by basically you take 1 minute bars, and then you can measure, you know, on average for each minute of the market day, how much of the daily volume has occurred by the end of that minute. And so you can plot a kind of a curve. So I ended up with a table of, you know, for each minute, expect this % of the daily volume to occur. And of course it's, you know, it goes like that, right? You got a big chunk near the open, and then it flattens out midday, and then you get a spike near the close. So, you know, for any given minute, I could just take the multiple for that minute and then how much volume had occurred so far, and estimate how much would occur by the close.
Mm-hmm. Okay. All right. Interesting.
And then compare that to the previous 20-day average volume, or the 10-day average, or whatever you want to use. And that would determine whether it was unusual.
Yeah. Something you emphasized in the book, and it's like a balancing act, I feel like, right, is over optimizing your system, right? Because we want to shoot for that, like, what's the optimal strategy? What is this here and there? But you can go too far, right?
Mm-hmm.
Yeah. Can you just speak to that?
Oh, for sure. Yeah. I mean, and it's that problem is more acute if you're building a system for a single market. Like, you know, futures traders will or many futures traders will just pick one thing, like, you know, the ES or whatever, and find a strategy for that one market. And then you got to really be careful to not over optimize and use all sorts of techniques like walk forward and in sample, out of sample, and so on. And I think I had an intuition that was a problem right away when I got into backtesting, and my emphasis from the beginning was on you know, portfolio level approach instead. So I was trying to model a process where I scan the whole stock market every day for trades and take a fairly small number, using a different set of symbols every day. And to this day, that's still my approach. I mean, any given symbol, I might trade it 2 or 3 times a year, and I'll probably trade 300 or 400 different stocks during the course of any one year, because it's just whatever ones come up on a daily scan for the signal that I'm looking for. So it's harder to over optimize, but it's still possible. I mean, you know, when you backtest, you know, there's I don't know, 1 trillion possible trades that could occur on any given day in the market, or maybe it's 100 trillion. I don't know what the number is. Whatever. There's some astronomical number of trades that could occur, and backtesting is really just a process of filtering that down to some subset that you would theoretically have taken, right? And you know, you can keep filtering and filtering and filtering until you only take the winning trades every day if you let yourself add enough parameters.
Yeah.
So, you know, you just have to be aware of that risk and decide not to do it. You know, if you find yourself wanting to remove the most recent drawdown from your equity curve by putting in a new rule, that's probably over optimizing. And I used to do that. I mean, the funny thing is, and I didn't know anything for like at least the first 10 years I was doing this. I just wrote my own software and used it, and I didn't read any books about it. So I was just kind of inventing it as I went along and doing it fairly stupidly. I mean, according to any book you read about how to develop systems and do backtesting, but I don't know, somehow it worked well enough. But now I'm less inclined to add lots of more rules to systems, and I'd rather add another strategy that's not correlated with the ones I have.
Right, which makes a lot of sense. Yeah, I think the part you mentioned with like the drawdowns, that's probably when people start probably going too crazy, like, okay, let me add this, how do I remove it, when sometimes just the ebb and flow, you know, just how the way things go. Marsten,
it's inevitable. I mean, nobody, you go back and retest things when you're in a drawdown. Everybody does that. You know, when you're hitting new equity highs, why would you change your rules? Although I do sometimes. I mean, if I think of something that makes more sense to me, or find a way to simplify a strategy, I might put that change in, even if it's working great at that moment. Yeah,
for sure. I think a common theme in modeling or back testing is that keeping it simpler is better. And you know, shout out to Ed Thorpe. That was like something he really like emphasized in his book. And come on, Ed, come on the podcast too. We're trying to get him on here. Shout out to Ed Thorpe. But yeah, no, that's one thing he really emphasized, is that like, no, like his like genius, quote unquote genius, is that he could like simplify things. And that's something you also referenced as well in your book. But this is a hard concept for people to grasp, huh?
Yeah, it is. You know, it's tempting, at least at first, to just do whatever it takes to make the equity curve look better. But yeah, I used to, if I had a parameter, you know, that like a moving average length, I would do every single, you know, like from 20 to 200, step 1, try them all or whatever, or you know, a multiplier, you know, like how many ATRs away from the moving average do you want to put a limit order? You know, let's optimize that to 2 decimal places. You know, so don't do that. I mean, over time, I developed a bias for round numbers. You know, like maybe I'll test 1 ATR and half an ATR, and 1.5.
Yeah.
And if there are better values between those, I don't care.
Yeah, for sure. In the book, you referenced biotech stocks a few times. Either not backtesting well for you, not having a good performance, trading them well. Well, what is it about the biotechs that doesn't fit into your models?
Well, I always included them for a long time, but then in 2013 I had my first losing year, and which was basically because the short side. As I said before, I was trading, buying breakouts, shorting breakdowns, so it was kind of short-term trend following approach. And around 2013 is when the style known as BTFD really became very popular, and that which basically is taking the other side of my short strategy, because my short strategy was, the stock was near a local high and then suddenly had a big drop, like 10%, and then I would short it, and that used to, those big, like a 10% drop from near a local high would always have several days of follow through until 2013. But not always. Nothing works always, but more often than not, so the strategy had a positive expectancy. So, but starting 2013 or late 2012, it just didn't work, and it really hasn't worked since. That's now a prime buy signal. And that kind of clued me into. I was maybe vaguely aware of the concept of mean reversion, but had never really explored it. So I started exploring it, and I added 2014. I divided my account in two and traded half of it with my existing strategies and the other half with a long short mean reversion pair that I had developed. And the mean reversion pair did great. It had a 40% year, which meant 20% to me, and my old two were flat. So then in 2015, I said, I'm going to just dump the old two, and put everything in mean reversion, and maybe even add a little leverage, because these things, it has an incredible smooth equity curve. And then I ended up having a 45% drawdown, because, and part of it was from Biotech. There was a time when, was it? Yeah, 2015. Right. I think it was like presidential primary season, and there was some point where it looked like Hillary was doing well, and then she tweeted something about going after the pharmaceuticals, and all those stocks tanked and kept dropping for days and days in a row. So the usual rules of mean reversion, where something rebounds typically after about 3 days of falling, did not apply to those. And I found that to be true, in general, that the biotech stocks tend to trend a little more than a lot of other sectors. And then, of course, on the short side, they're just perilous, because you never know when the next FDA results announcement is going to come out and the thing's going to quadruple overnight or whatever.
Exactly.
So you don't want to be short those things overnight. I will short. Now I trade an overnight mean reversion strategy pair and an intraday mean reversion strategy pair, and I'll include biotech in the intraday, but I won't short them overnight.
Yeah.
Excuse me, can I just ask? Just Ray will know this. Is there a way for you guys to put in supply somehow with that strategy, so you guys don't get roasted? Like,
what does that mean?
Like putting in, so you're not shorting something where there's no supply. Like, say that 10% drop nowadays, because they warehouse so much stock. Nobody actually ever sells stock, because we don't need to, because interest rates are low. So nobody sells to cash out. So they just keep taking prices higher and putting away stock. And you see that in GME was one of those cases, and a lot of these cases where the floats are locked. Is there any way that you're like, because I know Ray does stuff with short scans and stuff like that with float, percent short of float. Any way to use that to keep you out of that kind of a trade? And
I was going to ask you that question today, actually, because short interest data is only published twice a month.
True, but I can, if you ever need any, I just look at a stock and I can look at the structure of the company, because I've taken a couple of hundred of them public. So when I take a company public, I build a short position into it.
Yeah.
Right, because it helps you keep the price up, so you don't have to work as hard to bring buying into it.
Yeah, I
Right.
remember when my company went public in 1996, how they supported the price for a
Yeah.
quarter.
Yeah, exactly. Right. Just we hold it up so we can sell it.
Right.
Right. Because it's a market.
Right.
It's just like a fish market, except here we're selling paper. But I'm just
yeah,
curious.
in the last few months, when my short strategy have started to struggle again, I'm definitely interested in that. I mean, so far the only thing I've found is what I mentioned earlier with the looking at the borrow rates and the margin rates that IB has.
Some of these deals, if you just look at the structure, you can tell you'll see like 125% of the float is short or some crazy thing like that. Then there's something that's immediately a red flag, right? Stay away.
Yeah.
Because there's just no supply. Because a lot of times these companies will talk to funders. The funders will pre-short the stock to get the price down for the offering, and then the company will walk away from it, and those people are short.
Well,
Usually they can bully it down, but when the street takes the stock, that's when you get caught.
well, that's why some of these things, Jay, I think, I mean, I keep in mind when I backtest them, right? But like Marsten said, a lot of these statistics are fluid, right? They're changing. The short flow to short interest, institutionally held. But those are things I do put into the test to see if I can see something.
Cool.
But I think that's where you got to use some of your eyes sometimes, Jay, right?
Yeah. I mean,
use your eyes, you know what I'm saying, to see. Because there's some things that the numbers can't capture as well. I don't know. Would you agree, Marsten?
Yeah, I mean, I would love to be able to test that. I mean, I don't currently have a source of data even for, I mean, I have the current float. You can get the current float, current short interest.
Oh yeah.
But I can't get, point in time historical float or point in time historical short interest, so I can
That's true.
build a model of, what thresholds to use.
Oh, okay.
Which is what I would need to do, because I can't see. It's
Ah,
hard for you to imagine, but I'm constrained by my refusal to make any judgment. Like, I literally do not want to know the name of any stock I'm trading. I don't.
Oh, that's good.
I love it.
I love that part. I love that part.
Right.
I love it. So extreme. No, it's great. That's awesome.
Beautiful.
I mean, I know I have some positions on, over this weekend, but I couldn't tell you what they are. I have no idea. I could open IB and look, but it's like,
that's a real trader. That's a real trader right there, Jay. I love it.
Definitely.
Like we have a former CBOE floor trader in our group of traders, and that's what he has no idea what he's like. I don't give a shit what this company does. I don't even know what it is. Whatever, it don't matter. I just follow flow. I just follow flow.
Flow. Yeah. Just go with the flow. Go with the flow.
Yeah.
And I want a set of rules that I can apply every day that will print money. That's basically what I'm looking for.
Yeah. So, Marsten, while we're on the topic of shorting, and JJ, I love shorting. But Marsten, it's how are you been faring on the short strategies as of late? It seems a little difficult nowadays.
Oh yeah. The short side has been in a drawdown since mid-December. I mean, I've had some winners, but on average, they haven't worked. It's because it seems, I don't know how much of it is the Wall Street bets thing or what, but the market has shifted to this mode of buy whatever's the most overbought.
Mm-hmm.
And
well,
which is exactly, and that wasn't the case. I mean, the kind of you can put in a measure of what's starting to be ridiculously overbought, and then it goes up even more tomorrow, short it there, and on average that has worked for the past 20 years. It didn't work. I mean, I've been aware all along that this strategy I run did really badly in 1999 and early 2000. But I've just assumed that that was unique. That's not going to happen again.
Well, here's the thing.
And here it is happening again.
But here's the thing, and the reason for that is because the industry changed from a commission-based model to an asset allocation model and an assets under management model. So the more assets they gather, they don't need to sell them. They won't sell them. The more assets they gather, the higher the fees, right? That's how they're making their money. And so if you don't ever sell anything, how is there any supply to force the price down so you can short?
It sounds like a dangerous game to me. I mean, it's like a Ponzi scheme. Eventually,
Marsten, look at the daily volume of Apple compared to its float. less than 1% of the float of that stock trades.
Yeah.
That's scary. If one of
Yeah.
those funds came out of 300 million shares of Apple, the stock would be $2.
Right. Right. And that's why I think it's so ludicrous when people talk about, how wealthy, Elon Musk is, et cetera. I mean, yeah, on paper, but
Exactly. But
Mm.
try and
he
sell
can't
all that
cash out.
paper.
Yeah.
You have to create a market to sell that stock into.
Right.
Interesting. Wow, I never thought of that. Good point, Jay. Wow.
So yeah, I mean, that's the burning question for me right now is do I keep running these strategies every day that are losing money, or I mean, are they permanently broken? Is it, in the short, I tend to, they have little drawdown climax days, and I'm thinking, okay, this is it, I better shut it off, and then I always get a really nice rebound the next day.
Yeah.
Yeah, that's true. Yeah, exactly. Right. It's just the certain stocks that you just are just like, you just want to stay away from. Right.
Right.
Like, those things that like, there's something fishy. Even if your gut feeling says there's something fishy about it, when you look at the structure, just walk away from it. Right. It's and pick another banana to peel.
Yeah. I guess I need to start. I mean, I'm starting to get a little feel. I did, save myself some money by noticing the Robinhood Wall Street Bets trend and putting a few of those on my exclude list
Yeah.
eventually. But I got burned by like BBBY. But like XONE, what's up with that? That thing just goes straight up every day with no pullbacks.
Yeah, there's no
It's a
supply.
3D printer company or something.
Oh, yeah.
Well, those are always good. Those always bring lots of retail. 3D printer companies and also treasure hunter deals are wonderful for retail buying.
There's so many things that are just like vertical, and like Marsten is the same thing. Like I've been really choosy with my shorts though. Like I'm a little different. Like I don't take every trade that shows up on my system, and like I'll scan it with my eyes. Let me see, where's this company from? Like these Chinese companies I've been trying to short just don't go down. And Jay, they're probably scams, right? Like you look at these things.
Well, yes. Let's say they're massaged. Yeah, I mean,
it's insane.
but
Now.
I mean, these guys are just selling paper. So
Right.
many of these companies, the primary business model is selling worthless paper into retail buying and U.S. buying. It's
I first came across that in that big drawdown I had in 2015. There were two. The biotech thing I described before was actually the second leg. The first leg, it was June 2015 when I kept shorting Chinese names and they kept going up.
It's incredible.
That was the first half of that.
Yeah, they don't let these things go down, or they hold them up
Yeah.
for a long time. It's insane. And Marsten, almost a counterintuitive point when I first started backtesting, and it's something that you speak to in the book as well, so it was good to see it, is that stops can actually be detrimental to your profitability if they're implemented incorrectly. Can you just expand on that?
Yeah, that actually gets back to the discretionary versus systematic question as well, because it's you hear these rules for discretionary traders like cut your losses short and let your winners run, and yet I've never seen a mechanical system that implements that and does really well. I mean, but every good equity curve from a mechanical system has either no stops or wide stops.
Yeah.
So it's kind of a paradox. But I mean, I actually don't use stops in any of my strategies, but at all. Price stops, like putting a stop order in the market. I have exit rules at the close of, if the price, like for a trend following type strategy, I might exit if it's closing at a 3-day low or something like that. But I found really early on that at close only stops really do better than live stops because you avoid the whipsaw and so on. But that's all with the assumption that you're creating a whole portfolio of symbols and never putting a huge amount of account in any one symbol. I mean, if you're a discretionary trader who wants to fully margin up in Tesla or whatever, you better have a pretty tight stop. So it depends. I mean, to some extent, I've also always assumed that if I'm holding a position overnight, it could open at 0, or if it's a short, it could double or triple. So I never want to put more than like the most I'll put in any position is 10% of my account, and that's very aggressive.
Mm-hmm.
Yeah. And you know, typically it's 5%. You know, so okay, I might take a 5% loss, but I've always looked more at, like, to me, if you get a couple of trades that are 2 or 3% of your account hit out of 1,000 or 2,000 trades in a year, that it doesn't matter. You know, I'm more interested in what the drawdown profile is.
Sure, makes sense. So do you think, Marsten, you know, as we're like talking this out, do you think that this cut winners short, let runners run is almost kind of like a little BS euphemism that people say that's actually really not concrete and like just not mathematically sound? Or do you think?
No, I don't think that. I think that actually is a very important concept for a discretionary trader and for a, you know, trend following kind of strategy. I mean, that's what a trend following strategy does. It's just a question of what type of approach you're trading, and you know, how you want to implement your stops.
Yeah. I think in a lot of the market wizards in the book, it seemed like a common theme. They were like, hey, if the trade doesn't work right away, just cut it out. And so I guess, speaking to the intuitive factor you were talking about before, these guys are like picking entry points where the trade should be working right away, and if not, they're getting out. Yeah.
Right. Yeah. I once took a set of trades from this successful discretionary trader and put them in my backtesting software. Actually, my software includes the ability to backtest from a list of trades. So it can be useful. You know, like a discretionary trader can take their trades and you know, try imposing different rules on them, and how that could have helped. But anyway, yeah, I took a set of trades that were, you know, mostly had a nice equity curve, and this is a person who uses stops, and I tested different stop levels, and found that widening the stop substantially made no difference because the entries were so good.
Right.
But because this guy knew he was using tight stops, I think it adds a level of discipline. It's like, you don't take if you know you're forcing yourself to put a stop, you know, fairly nearby, you're not going to take an entry unless you think it's not going to hit it.
Yeah. It makes a lot of sense for sure. And and developing that discipline, Jay, right? Like that's so important.
That's tough, and that's the tough part of this type of trading is the discipline. Yeah, coming from the side that we had no discipline. So
I guess another interesting thing I took away from your interview that you came across when you're backtesting is that you found that using a short momentum strategy that uses a mean reversion entry. So what's a mean reversion entry? That's just one of that strategy is actually, it's actually my least good one, but it kind of is there as a hedge. It's really, you know, as I described, I used to use my shorting strategy that looked for a big breakdown and then went short, and that doesn't work anymore. And so periodically I will revisit that. And I found that if I take that basic concept of there was a really big breakdown, but then enter on a limit order if it bounces the next day, and then hold it like a trend following short. That works sometimes. I mean, that strategy was my best strategy last March, for example. And it's been a couple times since then that it's done well, but it's kind of like an insurance policy almost. It's just flat or even loses a little bit most of the time, but then it catches the big drops when they happen. So it's useful for that. All right, awesome, gotcha.
So really, it was just a way to take the old strategy I used to use and improve the entry.
Yeah. So I gather you take hedging rather. It's an important concept, right? Because, you know, I feel most systematic traders want to have systems. Well, we do, right? We want to be profitable no matter what the market does. Correct?
Right. I don't use hedging in any sort of formal sense. I mean, to me, hedging is like you've got an investment that's a long position that's always on, and then maybe you buy puts when the market looks iffy or something like. I don't do anything like that. I've never had this idea that I have to quote unquote have my money at work. Like to me, trading capital is just there so you can put on positions when the opportunities arise. But I do like to be running a mix of different strategies. Like to me, there's kind of now I think of a 4 points, a quad thing, which is long and short on one axis and momentum and mean reversion on the other axis. Mm-hmm. So you want to have each of those 4 check boxes checked off among your strategies, and then you're pretty well covered in most market conditions.
Yeah.
And you just do it bottom up. You take positions as the signals occur. So you let the market say which strategies have more investment at any given time. But the problem with only trading mean reversion, which I had that unfortunate experiment with in 2015, is that they actually don't hedge each other. If you think of mean reversion long, you're only buying something when it's dropping, and short, you're only shorting when it's rising. And so when the market starts to fall, you don't get any short signals, you just get long signals. And if it keeps falling, you're screwed. So that's where adding the other things in helps.
Right. So instead, because you were doing both mean reversion strategies, weren't hedging each other, then you went, if I remember correctly, long mean reversion, and then short momentum does help. Do they hedge each other, correct? Yeah.
Yeah, and vice versa. Long, since I told you my short strategy, my mean reversion short strategy has been bleeding since mid-December, but then my long momentum strategy, which focuses on recent IPOs, has been hitting it out of the park. So, the net result is positive.
Yeah.
But of course, now I wish I'd just shut the short side down, but what can you do?
Easier in hindsight. Yeah. Marsten, one of your parting words in the book I liked. You said develop an appreciation for the randomness in the market.
Totally.
Can you just expand on that thought, what that means to you?
Well, one thing it means is that, so you're running a strategy that you backtested, and it has thousands of trades in the backtest, and it's going to make 1,000 trades in a year. So it really doesn't matter what today's position does. It's just one of 1,000 trades. But also, and understanding that helps. It helps with not getting too attached to any given concept. And even at the system development level, like whether one version of a system is going to do better than another version of a system in the future, you have no idea. There's no way you can even predict which one will do better. It's kind of an acceptance of what you can't predict and what you can't forecast. I also specifically use randomness in my backtesting. I'll randomize parameters. I'll run 1,000 tests with a range of random values for a parameter, and then look at the set of results, and I'll assume, at best I'll probably get whatever the median value from that set is, as opposed to the very best one.
Yeah, I like it.
It's kind of like anti-optimizing.
Yeah. No, that makes total sense though. I really like that. That's unique, interesting. You have Marsten, you have software for purchase for some of the listeners who might be interested in this nerd stuff we've been talking. Tell them a little bit about the software you got.
Yeah, I have a backtesting software product which I call Real Test, which it's just literally been, it just kind of evolved for 20 years. And then in the last couple of years, I made a big push to bring it to a new level so that other people could use it better. Of course, having this book coming out is somewhat of a catalyst. Like I might as well take advantage of that opportunity and sell it. But I don't have big plans to. Revenue from selling software is not going to be my main income.
Yeah.
But it just it helps pay for the expenses of supporting it and everything. But yeah, it's a portfolio level back tester, and it also makes it really easy to combine multiple strategies into a model. So you can, everything I'm running, I can run as one back test, and I can see the combined equity curve and all the equity curves of the strategies within it. And I've got a scripting syntax that makes it pretty easy. I've had quite a few people who really aren't programmers who've been able to figure it out, and who had struggled with other backtesting products.
Mm-hmm.
So I think I found a good balance of power and ease of use, which is kind of always the goal with software development.
Yeah, no, it is. Because someone like myself, Marsten, I do these things, but I'm not a programmer myself, so I need software like that
Right.
so I can have access to this stuff. So yeah,
and I also include a lot of example strategies, so that people, like, if you want to do a mean reversion system, you can find one that's there in my examples folder, and then you can start with that and tweak it. And
nice.
And there quite a few of them are currently profitable. So
yeah,
I'm not just giving people abstract examples that are useless.
Yeah, for sure. Comes with a template. No, that's awesome. Good stuff. Awesome. So JJ, before we wrap this episode up, do you got any questions for our boy?
No, I'm just really, it was a great learning experience. It's quite lovely to sit and learn about, the areas of the market that you don't know about. And this, is the first time that we've had a trader on the show who could play the Sibelius, which is, extremely, that is one of the coolest things. So it was lovely having
It's a wonderful concerto. I don't think I could play it today. It's kind of in this intense software development phase I've been going through, I've been neglecting the violin, but I will come back to it soon.
Good stuff. For all of those who tried and failed, thank you.
All right, so that's going to conclude today's episode of Confessions of a Market Maker. If you enjoyed the podcast, please rate and review it for us. If you'd like to trade with a professional and fun group of traders, we trade over at microefutures.com. Marsten, tell the listeners where they can find you. Anything else you want them to know?
Yeah, I'm on Twitter, Mars10P, that's MARS10P, and that'll help people remember how to spell my name. And I'm mhptrading.com is my website where you can see my software.
Yes. Go follow him on Twitter. Go check out the software. So for Marsten Parker, I'm Paulie Walnuts. He's a girl of the house street. Be easy. Thanks, Marsten.
Thank you.
Thank you.